Joining us now, talk about everything on the markets, Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Lori, good to see you.
Good to see you, too.
Maybe talk about some of the market dynamics in a minute, but I'm curious as to how you see the setup, broadly speaking. Earnings were so strong, at least on the cosmetic level.
Yeah.
Kind of the brute force of how strong they were has helped the market get unstuck. We hit these new highs last week. Now, I guess the question is the macro going to intrude on that, and can we extrapolate the good fundamentals from the earnings into next year?
Now, look, our supposition was that the growth trade was going to get back on its feet once earnings came back into focus. We had been sort of in this earnings lull while the market was broadening, and everyone said this is going to last. And we said, we've seen this story before. The growth trade got a little over its skis on valuation. We're not getting any earnings, and as soon as you kind of have to focus on that again, we're just going to go right back where we were. I think we had that unwind on the momentum trade that kind of delayed that a little bit. But the good news is that unwind in the momentum trade did completely kind of wash out the overvaluation problem that we had gotten in the big cap growth side of things. So, as we look forward, I will say, frankly, Mike, we put out our weekly a little bit late last night, and we said on these big positioning trades, U.S., non-U.S., growth value, small, large, we're not getting hugely strong signals right now. We're sort of biased in favor of growth in U.S. continuing to lead. But I'd be lying if I tell you it felt as, highly convicted a call as we had a couple weeks back. I think on the broad market, we're not seeing anything that says we're really kind of raising the risk of an imminent pullback. It wouldn't surprise me to take a little bit of a breather in here after this move we've had in early August. But generally, we think valuations are fine. Sentiment is subdued. Earnings are on track. We've got these annoying questions about what's happening with interest rates, and those can flare up at any time. So I would say be selective and stay on your toes.
Are those just annoying questions, or is that generally, kind of going to be the thing that determines whether we continue or not?
Well, look, we spend a lot of time on our valuation model and earnings model, which, basically look at the pressures on the PE from an interest rate and inflation perspective. How much does the PE kind of compress because of this trickier rates and inflation environment versus the strength in the earnings? And we haircut the consensus earnings over the next 12 months pretty heavily by about 10%. We put in some pretty onerous inflation assumptions. We're modeling in 3%, 4.75 on the 10-year yield, and then we've got a couple of hikes in, and we can still get you higher to about 80-50, right? And those are probably all way too conservative, right? So there's probably some upside risk to that number. But I do think, we do need to work through the Fed issues. One of the more popular charts in our deck right now looks at how the market's traded after Warsh took over and compares it to Yellen, Bernanke, and Powell. And all of his predecessors had problems out of the gate with the stock market. We had pretty choppy transitions. So to some extent, we're trying to calm people down a little bit and say this is normally what happens.
Yeah, I mean, obviously the conventional wisdom is markets always test a Fed chair. Yeah. And I think the other way of looking at that is the Fed chair always tests the market to kind of,
But I would say this, and I want to see that deck, by the way.
Okay. It's like 130 pages or something.
I want to see 2 pages of that deck. Janet Yellen was a labor economist. Okay, Ben Bernanke. These are all sort of wonky economist types. Kevin Warsh is a hedge fund manager. Was a hedge fund manager. He should know the market better than them. He shouldn't have to be tested because he was the market, wasn't he?
I think the market has a nasty habit of humbling everybody. I've been in this business for 26 years, and I don't think investors like change, right? They like the rules of the road as they understand them to be. And I sort of have some sympathy for the idea. I cover small caps, right, among everything else, and small caps constantly get jerked around by hedge funds in terms of, well, let's look at this CPI print or this NFP print. Is that good or bad for small caps? And we have these little arguments, and it's like, all that matters at the end of the day is what's the read through to the Fed, which can completely be opposite of what the fundamental signal should be. So I sort of have some sympathy for, wanting to kind of get back to fundamentals. But at the end of the day, it does take time for markets to adjust.
Do you think that the markets could withstand a series of rate hikes at these levels? I mean, obviously they're pricing in a 50-50 split in terms of probability for a hike in September, but how much of that is already priced in? And do you think that if inflation is the risk out there, that equity markets could withstand, a response to that?
So, look, I think you're threading a needle like with everything, right? We don't want inflation to get out of control. But if we look historically, and I always say, you try to stick to the numbers on these things. If we go back historically to 1990 and look at 12-month periods and what did the Fed do cumulatively over that 12-month period, The market does just fine when you have up to 4 hikes. Your average returns are about 13.7%. But if you do more than that, you start to really reduce your returns pretty dramatically. Similarly, on that valuation model I mentioned, if we start throwing in 4 hikes and push 10-year yields, up above 5%, push inflation to like 3.75 or 4.25, we're looking at flat to down equity markets over the next 12 months. So we can handle a bit, we can't handle a lot.
There's some line of thinking that, that the Fed could take back the 3 cuts from last year and kind of as a normalization move, we don't need the insurance, and then maybe that's within your band of not quite 4.
And I'll quote one equity investor I talked to maybe about like 4 to 6 weeks ago. So this is a little bit dated, but this was a large cap portfolio manager. And we were talking about disconnects. And I said, when I talk to macro people or fixed income people or FX people, they're all focused on rates. They're all concerned about the Fed. And I said, I just don't get the same thing from the stock picking crowd. Maybe that's changed a little bit now. But what this guy told me at the time is he said, of the 5 or 6 things I've got to worry about right now, the Fed is pretty low on the list.
Yeah, I mean, the composition of the index.
What about the midterms? They matter?
The midterms? Yeah, the midterms do matter, and you do tend to, now look, every midterm election year marches to its own beat. The timing is always different, but what you see on balance is that you get pressure on the equity market in the summer heading into the midterms. I just got back from Australia. It was a hot topic in meetings, and it tends to be a hot topic, midterms, policy, elections, when you're talking to international investors much more so than inside the States. Yeah.